Hey everyone, welcome back to the channel. Now, before I begin, if there are any companies you'd like me to dig deeper into and make a video on, let me know in the comments section, all right? So let me toss out a quick question. Have you been keeping an eye out on Alibaba lately? This is one of those stocks that always seems to stir up strong opinions. Today I'm going to break down the key points about Alibaba's latest performance and show you why I'm feeling pretty bullish about it right now. If you're curious about what's really going on behind the scenes, revenue numbers, their cloud business, moves overseas, and how they're shifting gears in China, stick around. I promise we won't waste time. By the end of this, you'll see why I think Alibaba's got some serious potential for anyone looking for a decent investment idea. So let's dive right in. All right, first things first, the numbers. So Alibaba's Q2 revenue for the 2025 fiscal year came in at 33.7 billion, up from 30.81 billion. That's roughly a 10% jump, actually a 9.4% jump. Not exactly a small bump. Net income climbed to 5.2 billion from 3.8 billion, which signals that despite any economic anxieties, they're still pulling in some solid profits. Now, there's a bit of a hiccup when it comes to operating cash flow, which dipped from 6.75 billion to 4.48 billion. Cash flow is the lifeblood of any business, so that's something to watch for. Their EBITDA barely moved, going from 6.75 billion to 6.74 billion, so it's a flat line right there. Zooming out for the first half of 2025 as a whole, revenue rose 68.36 billion from 62.9 billion, while net income climbed to 10.15 billion from 8.5 billion. Overall, the big take is that they're still growing, even if operating cash flow didn't keep pace this time around. Now let's talk about Taobao and Tmall. These two platforms remain the beating heart of Alibaba's domestic commerce. Revenue for Taobao, and Tmall jumped from 13.39 billion to 14.11 billion, up by about 5.4%. A large part of that gain comes from a solid 80% boost in wholesale revenue, plus a 2% lift in customer management revenue that's tied to higher gross merchandise value and more orders. Interestingly, though, they saw more frequent purchases, even though the average order price took a slight dip. Direct sales in this segment dropped by 5%, mostly because demand for big home appliances is softer. No surprise there if folks are tightening up their budgets. Profits in this core segment slipped from 6.45 billion to 6.35 billion as they poured money into improving user experiences. That little drop in profit could be worth it if it keeps customers engaged long term. Next, the Cloud Intelligence Group. For a while now, Alibaba's cloud arm has been generating buzz as a big growth area. Revenue jumped from 3.79 billion to 4.22 billion, which is around 7.1% on a constant currency basis. The best part? Profitability is improving at a nice clip, rising from 193 million in Q2 2022 to 379 million in Q2 2025. They've been rolling out AI infrastructure, investing heavily in advanced models, and upgrading systems to handle more complex workloads. All of that costs a chunk of change, and if Alibaba can hold on to its lead in the Chinese cloud market, where it's already number one, and expand internationally, the upside looks huge. This is also where they're placing a lot of their bets for the future, especially in AI services, since that demand isn't likely to fade anytime soon. Now let's jump into the international side of their commerce. This segment grew from 3.36 billion to 4.51 billion, a 34% year-over-year boost. It seems like features like Choice plus Trendyol's continued success are driving a lot of that growth. Lazada is also getting more efficient at monetizing its user base, which is good news if you're hoping Alibaba can diversify beyond China. Of course, expansion doesn't come cheap. Losses here ballooned from 53 million to 414 million, showing that Alibaba is throwing serious money at global markets. You gotta ask yourself whether you believe these investments will pay off down the road. If so, then some short-term losses might be worth it for the international foothold that they'll be establishing. Another piece of the puzzle is Cainiao, Alibaba's logistics arm. Revenue rose from 3.13 billion to 3.51 billion, about a 12% increase, helped along by cross-border fulfillment. Profits, on the other hand, pretty much collapsed, sliding from 124 million to 8 million. That's a massive draw. But shipping and logistics are tough, capital-intensive businesses, especially when you're trying to offer speed and reliability. Alibaba's continuing to invest in its fulfillment solutions. which could pay off improved delivery times and an edge over competitors, but for now, it's hurting the bottom line. Speaking of other segments, local services saw a nice jump in revenue from 2.11 billion to 2.53 billion. That's a 19.5% climb, powered by everything from direct-to-consumer delivery to marketing campaigns. The silver lining is that losses dropped dramatically, going from 351 million to 56 million. So not only are they making more money, but now they're finally reining in some of the spending. Efficiency and scale appear to be the name of the game here. On the asset management front, Alibaba's unloading some non-core pieces. They're looking to sell in time their department store chain and expect 1 billion in gross proceeds. Problem is, they'll be taking a 1.3 billion investment loss. That's a punch in the gut, but if they're pivoting away from old school brick and mortar assets, it might help them refocus on core e-commerce, cloud, and AI-driven businesses. The sale still has to clear regulatory hurdles, though, so don't count those chickens just yet. Now, about Alibaba's place in the broader market. They're among the top 5 global cloud providers, which is no small feat. Although they're not top 2, some investors argue that Alibaba's price is too low given its fundamentals. Things like revenue growth, net income, and that chunk of cash on the balance sheet. Indeed, the stock trades at less than 10 times projected earnings for fiscal 2025, dipping to the high single digits for 2026 and 2027. If you compare that to other tech giants, it stands out as a bargain, though it's also got higher geopolitical risks, of course. China's economy has slowed down a bit, and political tensions remain a worry, so the discount might reflect that. A forward earnings yield of above 10% doesn't show up every day for such a large, diverse company. Now let's talk about that cash real quick, right? Alibaba's got around 25.5 billion in net cash, about 13.2% of its market cap. That war chest can fund buybacks, expansions, or even dividends if they decide it's time to appeal to a different group of investors. In 2024, they spent 16 billion on share repurchases, slicing down their outstanding shares by over 7%. Lately, though, those buybacks have slowed to 1.3 billion in Q4. Now, switching to macro factors, China's government has rolled out all kinds of stimulus measures since late 2024. From cutting the reverse requirement ratio to injecting money into local governments, they also shifted to a more moderately loose monetary policy, which suggests they're serious about stoking consumer demand and helping businesses along. If these measures take hold, Alibaba could ride that wave of improved sentiment and spending. Obviously, there is no guarantee, but it's a reason to keep an eye out on how economic policy unfolds. Now, on the technical side, Alibaba's stock has been bouncing around for about 3 months now. If you're a chart watcher, you might notice it forming what some interpret as a higher low, potentially setting the stage for a long-term uptrend. Of course, technical analysis isn't gospel, but it can prompt big institutional players to jump in once certain price points get confirmed. If you're into options, implied volatility for Alibaba stock is sitting around 30%. That might look appealing if you think volatility could spike again, because the value of those calls could shoot up even if the stock itself only moves modestly. Competition is another piece of the story, right? PDD is growing revenue at a rate that dwarfs Alibaba's in certain segments. Shein and ByteDance aren't slouches either. They're both going hard in the e-commerce space. But Alibaba is hardly playing defense. They're merging their domestic and international commerce groups to share resources and expertise. And they're streamlining by dumping assets like InTime and possibly SunArt. By focusing on their profitable core and investing in emerging technologies, they're betting they can stay on top of the game in the long run. Geopolitical risks, sure, they do exist, especially if tariff disputes flare up. And an administration that slaps a heavy tariff on Chinese goods could crimp growth, not just for Alibaba though, but for anyone doing business with or in China. These are the kinds of macro headwinds that have kept valuations lower than you might expect. But if the worst is already priced in, there's room for upside when the pendulum swings back, betting they can stay on top of the game in the long run. Another angle is that Alibaba's become much more than just an e-commerce juggernaut. They're shaping up to be a serious tech and AI player. Their cloud intelligence group investments, everything from advanced AI models to improved API calling, could set them up to challenge overseas rivals. The domestic Chinese market for cloud is massive, and Alibaba holds a major chunk of it. If AI demand keeps accelerating, that could significantly boost their cloud revenues and shift the spotlight away from their concerns about short-term e-commerce growth. So where does this all leave us? In short, Alibaba is facing its fair share of challenges. The Chinese economy isn't firing on all cylinders. Political tensions haven't magically just disappeared, and domestic competition is fierce, but they also have a huge worldwide footprint, deep pockets, diversified revenue streams, and a growing cloud business that might be the real gem down the road. Share buybacks show management's confidence, and the sale of lower priority assets indicates they're serious about refocusing their strategy. So the bottom line, I think that this is a buy. Maybe not an all-in bet the farm kind of buy, nor should it ever be, but definitely worth considering for a portion of your portfolio. The valuation looks just too cheap given the growth potential in AI, cloud, and international expansion. If China's stimulus packages and shifting monetary policy bolster the economy, and if Alibaba continues funneling resources into tech innovations, then the upside could be pretty substantial over time. There's a risk, obviously, but that's the trade-off when you buy stock that's flying under the radar of many investors who are still wary of Chinese equities. If you believe in the long-term trajectory of tech, e-commerce, and AI in China, Alibaba might offer a compelling blend of risk and reward. Thanks for hanging out with me today. If you found this breakful helpful, make sure you stick around for more content coming your way soon. I'll catch you in the next one.